So, the weekly current affairs that we will be discussing today are as follows on this screen. So, we will be discussing one topic with respect to the mains and the four topics with respect to the prelim examination. Without wasting any time, let's start. As you know that I take these following sources to curate current affairs for the UPSC Civil Service Examination. However, you can use these current affairs for many other service examination, including the Indian Economic Service, the UGC NET examination, and in fact, the state PCS. So let's start with the first topic. So the first topic for today's discussion is with respect to the GST collection. Now, Government of India has claimed that GST this year has broke all the records. No doubt it's correct. We have already crossed 22 lakh crore rupees of GST collection this year. But the more important thing is that this year GST has completed 8 complete years. Now, this law took place after so much of deliberation, discussion, and shows one of the best example of cooperative federalism as well as the fiscal federalism. This law brings us a unified one nation, one tax dream that we have been looking around for the last 30-35 years. And since its beginning in July 2017, GST has been a good performer overall, even as per the latest data. So we'll be discussing about GST, but before discussing about this means related topic, let's delve into the news articles. So I have curated 3 news reports from here. 8 years of GST, there's a elongated article that you can go through. It's given the PIB, that is Press Information Bureau. You can Google it around, you can find the article, and too much of detail is mentioned over there. Apart from that, we also find the GST turns 8 in the Business Standard newspaper. So this article also provides a lot of information, and apart from that, Economic Times has also published a good article on the performance of GST in the last 8 years. Is this topic important for the mains? Yes. Is this topic important for the prelims? Yes, absolutely yes. How do we know that? Look at these questions. 2017 UPSC asked a question on a direct question on goods and service tax. Multiple options, answer is mentioned on the screen. In the similar fashion, UPSC asked in the 2018, because 2017 was the year when it was implemented. 2018 was the year when there were too many issues with respect to the inclusion and the exclusion of the items which are there for the GST. Now, not only prelims, in fact, in the mains examination also, as you can see on the screen, in 2020, they asked a question on goods and service tax and 2019's COVID impact. So in the 2020 mains examination, they have asked that how Goods and Service Act, how COVID-19's impacted GST performance. Basically, it's compensation fund, right? Federal tensions. Then they asked in 2019, the year before, they asked that what are the indirect taxes which are included under the GST, which you can easily explain through a table, and a comment on the revenue implications of the GST introduced since 2017. So basically, guys, through these 4 questions, 2 prelims and 2 mains, I just wanted to convey one important message. The GST is extremely important for your UPSC preparation. Now, how much it is important? Let's go through that by word. So this is a takeaway. What UPSC has or could ask from the current affair. Now, recently, goods and service tax has completed 8 years since its rollout. So you can easily see 2017 to 2025. So 8 years they have roughly covered. Now, these are the 3 takeaways which are mentioned in the PIB also. So the source would here remain PIB. As I've told you, there's a elongated article which has been given by the PIB. Now, GST collection has crossed 22 lakh crore, which is 9.4% from the last year. It seems high, but no. We will dissect today the performance of GST in the last 5-6 years, especially pre-COVID and post-COVID, because this is how they are framing a question in the mains examination as well. So this seems high, but the actual collection was less than this, because 2 lakh crore, yes, 2 lakh crore will be deducted from this under the input tax credit or tax input credit. So that was given back. However, the final collection will be around 20 lakh crore. So we'll look around that as well. Recently, Deloitte has conducted a survey which says that as far as GST is concerned, so in the last 8 years, 85% of the people agree that it is a better regime than the pre-GST regime, that is whatever was there between 2017 or before the 2017, this is far better than that. Last, number of active GST taxpayer rose to over 1.5 crore people. It is less than it is around 1% of the entire population, but please understand that, guys, 1.5 is not you and me. We consumers are not part of this taxpayers. These are the taxpayers which are paying the tax on the like sellers, producers, shopkeepers, factory, manufacturing, service sector, those people who are involved in business. As a consumer, you are not part of this, because all of you know that there are far more consumers than 1.5 crore. What you should know about GST? See, most of the time students face this problem that they don't know about the basics of GST. Today, in this particular section, in this particular class, you can say, I'm going to discuss all the important topics for the GST and which will help you to cover up the preparation. Now, GST types. There are 4 types. Central GST, that is CGST. Then we have state GST. Then we have interstate GST, right? And then we have this Union Territory GST. Now, Union Territory GST, all of you know, it is implemented like in Ladakh, like in Delhi, like in Chandigarh, Andaman Nicobar, and all those areas. Now, legal authority, if it is a state GST, it will be created, implemented by the state government. If it is central GST, it will be done by the parliament. So state legislation and parliament are the respective authorities who can create laws on their respective ideas. Now, those union territories that have, you can say, their own state legislations, like Puducherry, Delhi, they can also create laws on that what items they want to include, what items they want to exclude, along with the GST Council. Now, apart from that, so one more important, very important thing, guys, state cannot create laws on central GST. Please understand that. Only central government, that is parliament, can create a law on IGST, CGST and UT GST. Central GST and state GST are imposed together. Yes, so whenever you see a bill, let's say you have purchased something and 18% of GST was implemented. Let's say you have purchased a mobile phone and there was 18% which was included as a GST. Now, whatever tax is being there, it is equally divided between the center and the state. Equally divided. So if it is 18%, you will get the total taxation that is going to be implemented. So tax imposed is 18%. Now, this is a composite scheme, right? Here, both center and the state are implementing the laws together, are implementing the taxes together. So they will decide, center will get, right, 9% and state will get 9%. Similarly, if the tax rate is 5%, 2.5, 2.5. If the tax rate is, let's say, 28%, 14 each, right? 14 to the center, 14 to the state. If it is 12%, 6 to the center, 6 to the state. This is known as a collective tax collection. Previously, central government taxes services and state governments could not tax services. Now, center and the state together are taxing the services in India. Now, given this, IGST, number 1, center and the state together. Please remember, the word is together. They charge taxes together but appropriated separately. The tax is imposed together as a 18%, but then they appropriate, that is, they keep their own respective share. IGST is to be distributed between center and the state in the manner it is provided by the parliament, because IGST is created by parliament. State cannot decide how it is going to be distributed. Now, what is IGST, what is CGST and SGST, we will discuss very soon. Parliament can impose cess and not surcharge on GST. Now, what is cess? Cess is a specialized tax collected for a specialized purpose. Like Kisan, this Krishi Kalyan cess, Swachh Bharat cess, education cess. They are collected for a specific purpose. So if government is collecting education cess, the money is going to be in the pocket for education purpose only. The money cannot be used anywhere else. On the other hand, surcharge means tax on tax. So let's say government is implementing 28% on GST. Then government can include certain surcharges if they wish. But look at this. Parliament can impose cess on GST and not surcharge. This is very important. Now the point is that this cess, which is included in the GST. So that is how it is being done. I'll come to that, how it is being created. So just remember this line. Outside GST, crude oil, diesel, petrol, natural gas and air turbine fuel, that is ATF, they are outside GST. There is a law. The constitution provides that the GST council can include this in future. Yes, there is a provision which says that these things, that is petroleum products, can be added to the GST in the future. Once added, there will be a uniform GST across India and uniform petrol prices. However, kerosene and LPG are already included. The first 5 are excluded right now, may be included in the future. The last 2, that is kerosene and LPG, are included. Center imposes excise duty and state imposes VAT. So the things which are outside the GST purview, right, that is crude oil, diesel, petrol, natural gas and air turbine fuel. These are the ones which are outside the GST. On this, center imposes excise duty and state imposes VAT. The same is true with alcohol also. So alcoholic drink are under the state VAT. It is not under the GST. That's why the alcoholic prices are different across India. Now, alcohol is outside GST, only states can impose taxes, as I've told you. It is also outside the GST. Additional excise duty, what is that? Is applicable on tobacco even after GST. Now, government has not named this as a surcharge. They are calling it as additional excise duty, and this is kind of a surcharge. It is not surcharge, it is kind of a surcharge. Surcharge directly they cannot impose. So, additional excise duty basically means that government can impose a kind of a penalty. So, this is kind of a penalty which government imposes after the GST. Any good or service not sold or consumed will not be covered under GST. Why? Because GST is a destination and consumption based tax. As it is destination and consumption based tax, anything which has not reached the final destination, anything which has not been consumed in the Indian territory is not covered under GST. Now let's understand this. The example is exports. Even the items which are sold to the SEZ, special economic zones. So exports or special economic zones, exports to the special economic zones, guys, please understand this. Let's say there's a company which is known as Maruti. Now Maruti company has created cars, right? Let's say they have created 100 cars which are sold in Delhi. So these 100 cars were sold in Delhi. The rest 100 cars were to be sold in Sri Lanka. Now, out of these two, which of them will be covered under GST? That's the question. Let me tell you which one. This one will be covered under GST because it is within domestic territory. It is domestic territory plus it is consumed in India. It is consumed in India. In this, it will be zero rated. What do you mean by zero rated? Zero rated means, of course, the manufacturer, that is Maruti, will have, I mean, if Maruti purchase some inputs, let's say machines, any electronic item, tires, steel, whatever they are purchasing, they will be paying GST on that as an input. So everything which they have included in terms of input will be reversed, right? Will be returned to them. So their net taxes, net payable taxes will be zero. So whatever taxes that they have included in the input will be given back to them by the government. They will be collected at first, but they will be given back. So that's a good news, right? Then, so exports are zero rated. This is the meaning of zero rated exports. Tax slabs, what is the ideal tax rate? 5%, 12%, 18% and 28%. All of the four rates are divided equally between the center and the state if they are collecting it together. Special rates for selected items. 3% if it is a gold, silver and diamond jewelry. 1.5% if it is with respect to the diamonds cut or polished, and 0.25 if it is on rough diamonds. Why? Guys, this is a specialized thing to promote export. This lower rate, first of all, gold, diamond, silver is culturally very important for India. It provides a huge employment, and secondly, India has one of the largest exports of gems and jewelry. That's why to promote exports, their rates are being kept at low. Then GST compensation says this extra amount of money was imposed as per the law. Parliament cannot impose it. It was already under the law for few years, which was later on expanded beyond 5 years because of the COVID. Now, under this, extra amount was collected in the taxation that was given to specific states. This was on tobacco, aerated drinks, motor vehicles. This additional tax was only imposed so that the states which are shifting to the new tax regime, because previously they had VAT. So many of the southern Indian states, they had this issue that as we are shifting to the new GST regime, they will have a loss on their revenue collection. So central government assured them, don't worry, we'll provide you compensation. So if you are supposed to collect 100 crores, you are collecting 80 crores, the rest 20 gap will be provided by the central government through the collection coming from GST compensation cess. Now let's come to the other dimensions, basically the core dimensions of GST. So here in this particular table, you will see what is the present status and what was the status before 2017, that is pre-GST status. So this single table will help you to understand all the dimensions of GST without any hustle. The first, GST is a one nation, one tax and one rate, which basically means that if you purchase a mobile phone in Jammu and Kashmir or Kanyakumari, or you purchase a mobile phone in Gujarat or Arunachal Pradesh, the tax rates are going to be same. If it is 18, it is 18 everywhere. And center and the states are going to divide this equally in 9 and 9% each. Previously, there were multiple taxes. Every state had their own taxes. That's why people take the advantage of buying from a specific state. Then both center and the state decide respective rates. Here in the present GST, previously there was multiple rates because both center and the states were trying to collect rates according to their own choices. Now there's GST Council. It is known as fiscal federalism. It is the best example of cooperative federalism, and here both of them decides the rates as per the consensus. So they come together to decide a rate, and that is being enforced. Then one unified national rate, hence same price everywhere. So the price may differ as per the raw material, cost of production, value addition. However, the tax are different. Here different rates, different regions, hence different prices. Now destination based tax. Destination based tax means the tax will be imposed only if it reaches the final destination. That is, the good service which has been produced is actually being consumed. So it is consumption based, paid by the party using final goods. Anyone who is using a particular product as an intermediate will not be covered in this. In that case, the tax will be reversed. They will get input back. Previously, it was origin based tax. That is, tax was imposed on the party which was generating the goods, irrespective. So there were the chances that if a good has been produced and it is lying idle in the store, right, in the warehousing or in the stocks, it has not been sold off, tax is still implemented on that. Three types of taxes here. Separate tax charged by center and the state. State had VAT, center has its own various taxes. Simple and easy compliance, very easy. Collection, appropriation, distribution, very, very complicated previously. It was very complicated. Plus it is digitized also. So it is digital, instant. Tax is applicable only on the value addition and not on the inputs. Input tax credit is available. That is, let's say there is raw material of something. So raw material is, let's say, so the raw material is wheat flour. Now wheat flour will be converted into final product, that is bread. So this is intermediate good, this is final good. Now according to GST, GST is implemented on the bread, right? So as it is implemented here, someone already paid a tax on this. So let's say shopkeeper has paid 12% tax on this wheat flour. Consumer is paying 18% tax on bread. Now this 18%, the actual price was 100. So the raw material costed to the shopkeeper was 112. Now 18% will be imposed on this 112. But what government will do now? Right? Government will say that this 12% will be cancelled out. Government will pay this back to the shopkeeper. And 18% will be imposed on the actual price. So the more value addition is being done, the more will be the GST, and whatever the tax was paid on the inputs by a particular person, by a particular seller, producer, manufacturer, service provider, that will be given back to them. This means cascading effect will not be there. So tax on tax, this was 18% was a tax on 12% tax already paid. So this will be avoided under the GST regime. So cascading will be avoided. Only value addition will be there. If value is added to something, then only tax will be imposed. If value is not added, tax will not be imposed. Each GST receipt is equally divided between center and the state. Previously, it was not the matter. Previously, collection, appropriation and its distribution was based on various agencies. For center different, for the state different, for the union territory it was different. That's why I said that it is more compliance related regime. Now coming to the difference. Center GST, state GST and integrated, or you can call it as this I can be also be changed with integrated or import or interstate, just to remember it. So integrated, state and center. Now these two are imposed together. That's why I'm putting a plus sign. These two are same. Their compliance is same. Their collection is same. They are distributed between the both parties. So they are imposed together. Center and state in intra-state, within the state. So this is within state. So this is the case. This is within the state. That is interstate, right? Between the states. So it is within the state, that is between the states. Governing authority, obviously under center, obviously under state. This is also under center. Revenue distribution, center, it will go into the pocket of center. So the tax collected under CGST will go in the pocket of center. Tax collected under the state will go in the pocket of state. Now this will be shared between center and the state as per the law created by the parliament, which I discussed previously. Law. It is as per the center GST law 2017, state GST law 2017, integrated GST law 2017. Example. Within Maharashtra or within Karnataka, or you can change the other example, sales of the goods going between Maharashtra and Karnataka. So sale of goods from Maharashtra to Gujarat or Karnataka, whatever example you can say. So that is between the state, within the state. So this is how this setup is all about. The same works with the UT GST as well. Now this is where UPSC has asked the question in the mains examination. So let's understand that. What state related tax have been included and what central related taxes have been included in the GST. Now central state related taxes are the value added tax, which was the largest share to the state before the GST. That's why they were asking for compensation. After this, entertainment tax. Please understand one thing, entertainment tax at the local government can be as per their choices. It is only up to the district level or at the state level, I would say. Luxury tax, tax on lottery, gambling and betting. So that you have this online betting platforms these days, they are part of this only. Octroi or the entry tax. If a person or if a good is entering a particular state on the borders of the state, they will be paying entry tax or the octroi, also known as chungi. This is not a toll tax, by the way. Toll tax is paid after specific kilometers for the using of highway. This is entry tax to a particular territory. Purchase tax on purchase of something. Tax on advertisements. And central sales tax, central imposes, state collected. Central sales tax like VAT, it was collected by the state. So all these are now part of GST. What has been included from the center side? Central excise duty. Excise duty is imposed on the goods which is being manufactured and just come out of the factory. Once it is finally produced and coming out of the factory, central excise duty is being imposed. Then additional excise duty, kind of surcharge, not surcharge, kind of surcharge. These are additional because they are imposed over and above the existing ones. Similarly, additional custom duty, that is countervailing duty, it is imposed to prevent the trade from kind of a mispractices or malpractices. Additional special additional duty of custom, again kind of a surcharge. Service tax, excise service tax, which was not with the state government, now it is between both. And as excise duty levied under the medicinal and the toiletry preparations, which includes narcotic drugs, alcoholic, right, which contains alcoholic, narcotic drugs, but not alcohol. Basically something produced out of it for medicinal purposes. So all these kind of taxes are now under GST. And that's why they are both center and the state divide them equally under them. Then important terms related to the GST. These important terms are, first, revenue neutral rate. Now the biggest question which was there while GST was implementing, that what if the total revenue collection to the specific states get denied or actually being reduced after the imposition of GST? What will happen in that case? That's the biggest question. That is, if all the states shift towards the GST, will there be a loss or not? So the question was that what should be the ideal average tax collection rate which will keep us at the same level of revenue generation? That is, what kind of a tax rate should be there which neither increase the revenue too much or nor decrease it too much. So it keeps it on the same revenue collection rate. So what rate should be that? So that is known as revenue neutral rate. So your revenue should be same as that they were before. Unfortunately, the revenue neutral rate should be 15.5% average, but it is 11.8%. So still government is sacrificing, both center and the state are actually sacrificing. To increase this from 11.8 to 15.5, a lot of tax rates should be increased. But given the country, given the present status, we cannot do that. Then comes a tax input credit, which I have already explained to you. If a person has already paid GST, if a manufacturer has already paid a GST in their inputs, so when they transfer the inputs into the final product after value addition, the tax they have paid on the input will be reimbursed by the government. So that is tax input credit. It is credited by the government back to the seller. or the producer or the manufacturer. Inward duty structure is kind of a miscalculations, it's kind of a malpractice. It basically means that when the tax paid on the input is higher than the tax collected on the output. Because when taxes, let's say on input, the tax was 18%. On the output, it was 12%. So government is collecting 12%, but government is reimbursing 18%. So it's a loss to the government, a 6% loss. Then zero rated supply. Zero rated supply are the ones which are export and the sales related. So whatever I have paid as an GST, I will get back. Zero taxes. Nil rated supply. Goods and supply of goods and service with zero GST. Zero GST. Now, in the difference between the two is, in the first one, I am paying something, but I am getting it back. Maybe 5%, 12%, whatever. I am getting it back. 100% return. But here, I am not even paying anything. Here, it is zero. Then comes non-GST supply, goods which are outside GST, like we have seen petroleum products, alcohol and others. Reverse charge mechanism. Reverse charge mechanism is when GST shall be paid and deposited within the government by the recipient. Let's understand this. It's very interesting. Let's say there's a company which is known as Maruti. Now Maruti is selling a car. The car is Swift. And the GST on this car, I'm assuming, was 1 lakh rupee. Right? This is GST. This is your GST. Now here you have consumer or the buyer of this car. Now actually this GST of 1 lakh will be paid by the consumer to Maruti, and Maruti then it will pay to the government. Because this is an indirect tax. Indirect tax means the one who pay is not the one who actually used the material. So the material was consumed, the product was consumed by consumer, but he is not paying the tax. Who is paying the tax? Maruti is paying the tax to the government. Maruti has collected 1 lakh rupees from the consumer in the price of the product, and then they have paid this to the government. Now reverse charge mechanism means what? Reverse charge mechanism simply means that Maruti will sell the product without GST to this consumer, and consumer will pay the GST to the government. Consumer will pay GST to the government, 1 lakh. Seems kind of impossible things, but at a larger scale this happens. At an industrial rate it happens. Alright, so that's an important mechanism in this regard. Moving ahead. Now present status of GST, which was mentioned in the article, so let's take this very quickly. Now GST, the net of refunds means what was returned back in the form of credit, input tax or tax input credit, is now around 12 lakh. So 2.5 lakh was paid in the reverse. Average annual receipt is 3 times the receipt of pre-GST period. So if before GST, that is before 2017, we were collecting 5 lakh crore. So now it is 15 lakh crore. It is 3 times. So GST overall has increased too much. Growth rate, however, is lower. So if previously, that is pre-GST, right, or pre-COVID, the growth rate was kind of, let's say 10%. So now it is 9% or 8%. So not too much decline, but it's less, because of the COVID and shutting down of the many industries and structural changes. Collection to gross GDP ratio is yet to match the pre-GST. Too many exemptions are given now. So the collection is not up to collection to GDP. Collection to GDP. That is out of the entire GDP that we have like $4.2 trillion GDP. Out of this, how much is coming from GST only? And now please understand, in this, I would like to add up that indirect taxes are now less than direct taxes. This is very important, guys. Now in direct taxes, specifically corporate tax and income tax, they are taking higher role, higher share in the GDP compared to the indirect taxes. Hence the role of GST is declining and the role of corporate and income tax is increasing. Average annual growth rate of GST in the most lagged state is higher than the national average. Now, which state I am talking about? Here I am talking about Bihar, I am talking about Uttar Pradesh, Madhya Pradesh. The rate of growth in these states is far more than the national average. So they are performing better in terms of GST collection. Let's see this through graphs. So as you can see, previously the average collection from the state, right, collection of this GST average, right, pre-GST is 3.73 lakh crore. Now it has increased to 14. Overall the average has increased, but it has declined, right? Here it has declined, right? Then average growth, that is growth rate of GST, 11%. It was growing average on an 11.8%. The growth rate has declined. Ratio with GDP, right? Ratio to GDP, that is GST tax in case of GDP, it was 6.3%, 5.7%. So GDP to, GST to GDP ratio, it has declined. Tax buoyancy, that is how much tax increases with GDP, much faster, lesser, right? Now this is very interesting, guys. Look at Bihar, UP, Jharkhand, Madhya Pradesh, Chhattisgarh, and look at their average. 13%, very high. 11, almost 11, 11, 14, 13. It is higher than the national average. So the poor states are showing better results on GST as compared to the richer states. So their growth rate, one of the reasons because of this is base effect. Because they are growing at a lower base. That is, the previous data is far less in these states as compared to the next data. On the other side, Gujarat, Maharashtra, Goa, Punjab, Tamil Nadu, industrialized states, agricultural states, richer states, they have higher base. So previous year was already high. That's why this year the growth rate may not be very high. In absolute terms, obviously they are low. So here I am leaving you with these two practice questions. You can pause the video and you can go through this specific question on GST as well as the second one, which is this prelims related practice question. Not only this, I am leaving you with this mains related question on GST. So enumerate the indirect taxes which have been subsumed in the GST in India. Also comment on the revenue implications of the GST introduced in India since COVID period. So the tables, the data that was mentioned in the news article, you can use that to understand more. With this, let's now move to the next article. The next article is on the financial stability report of RBI. Now, financial stability is what? Financial stability report basically talks about an important phenomena, that how our country is resilient towards the internal and external shocks. That if something goes wrong in the economy, how our economy is going to proceed, how our economy is going to respond in this regard. So in this, RBI publishes a report which is known as Financial Stability Report. Now most of the newspapers, Economic Times, Business Standard, in fact Business Line, they have covered this news article. So let's understand how Indian economy has been resilient in the last 6 months, that is January to June. So do UPSC ask questions? Do state PCS ask questions with respect to the economy? Yes. With respect to the reports? Yes. So they have asked a question on Global Economic Prospect Report 2015. Next year also they asked a report on global financial stability. So this is a global financial stability. RBI publishes with respect to India's financial stability the similar report. Now let's see the means related topic. Questions. Examine the pattern and the trend of public expenditure. Faster economic growth requires increase in the share of manufacturing sector, right, and economic growth in the recent past. Now all these lines prove what? That UPSC asked 24, 23, 22. UPSC asked questions on the specific trends. What has just happened? The related issues. What has just happened in the last 1 year, 2 years? What were the major issues that government was facing? What were the major issues that the Indian economy was facing? What are your views on that, way forward, and other things? Now, this report will help you to understand how India functioned in the last 6 months. Let's go through that. So before anything else, let's start with what this report is all about. So this report is published by RBI half yearly, that is last week of June and last week of December every year. So it is published twice every year, June and December. Objective. Obviously, it is talking about financial stability. So it will look into resilience of the India's economy. How India's economy is strong, resilient towards internal and external shock. Prepared by a subcommittee under Financial Stability and Development Council. What it covers: global and domestic risk, whatever the risks are. Ability of the financial system, which includes banking system also. Can the Indian banking system withstand the international issues or domestic issues? Examine the key macroeconomic indicators like inflation, policy rates, right, GDP indicators, CPI, everything else. Monitor the level of non-performing assets, especially in the banks, because if NPA or non-performing assets in the banks are very high as a ratio, as a share, if it is in double digit, it's like a threat to the economy, because banking sector may collapse. However, what the report says is actually not that much of a stress. However, the report has given us a kind of a warning signs this time. Let's understand what those warning signs are. Now, the report that we have taken is taken from the website of RBI. So, on the website of RBI, this report has been mentioned explicitly. So, highlights have also been mentioned. Let's understand them one by one. Financial markets remain volatile. Volatile basically means, especially stock markets, the banking sector, the value in those sectors and markets have been going up and down very, very high. So volatility is very high. Then comes public debt. Public debt is increasing because most of the states are going with high fiscal deficit. They're spending more. Central government has been spending more. The reason is the COVID. So after COVID, just to bring back the economy on the last track, 7% of an annual growth rate, 8% of the annual growth rate, both center and the states have been making fiscal deficit as an attempt. Indian economy remains key driver of the sound macroeconomic fundamentals. Yes, this is true. So Indian economy's fundamentals are very strong. Be it the tax to GDP ratio, be it the export or you can say openness of the trade in India, be it the inflationary parameters, be it the policy rates, every parameter is sound and strong. Health, balance sheets of the banks are healthy, right? Even for the NBFC, it's healthy. We'll just look around that. Corporate balance sheet is strong. So banks, corporate sector, non-banking finance corporations, foreign exchange reserve, which has already crossed 700 billion, seems okay. But still, RBI has given a warning. Globally, the wars are taking place. Israel, Iran, wars have been taking place. We have already prepared a video on that. If you want to go, you can go through one of the current affairs we have discussed last month, in which we have talked about Iran-Israel conflict and the international repercussions. Similarly, India had a conflict with Pakistan. Russia, Ukraine are also at a war. Then Trump administration is trying to impose too many tariffs across the world. So that brings a kind of instability at the global level. So those instability are there, but still the report proves that India remain resilient. Indian economy remain resilient. Accommodative monetary policy has been adopted. So almost like 100 basis points have been sacrificed by the RBI in the last 2-3 monetary policies to keep the demand at the upper side. Now, when RBI is doing that, it is following the accommodative monetary policy. Robust capital buffers, multi-decadal low non-performing assets. So NPAs of the banks are all-time low now. Multi-decadal means for the last 30-40 years, it is now one of the lowest. Capital buffers are adequate with all the banks, so they are resilient. Most scheduled commercial banks have adequate capital buffers, which is right as per the minimum requirement. Non-banking finance companies remain healthy with sizable capital buffers. They are also on the healthier side. Consolidated solvency ratio in the insurance sector is also remained above the minimum threshold. So be insurance, be it banking, be it non-banking, be it the stock market, corporate bonds, government market, everything seems to be stable in this report. However, issues. Now comes the real problem. Now the report has highlighted that although Indian economy is very resilient, however, it still faces certain issues. What are those? As policy rate have declined, repo rate, CRR, SLR, CRR, repo rates have been declined. LAF has been very accommodative in the past few monetary policy reports. Despite that, now please understand this, the loan rate has declined. So the lending rate has declined. So loan rate has declined, but fixed deposit rate is high. So if I am as a consumer, because fixed deposit rates are not turned overnight, they do not change overnight, but lending rates may change. So as repo rate declines, as CRR declines, banks can put more money in the hands of the consumer, to attract business. However, with this, fixed deposit does not change. Now, the loan which they are offering at lower price, so they are selling at low, but they are buying at high. It means what? The bank's margin, which is known as net interest margin, is thinning. Thinning means it is becoming very, very small. So their margin is thinning up. As a result, there's a decline in the credit growth, especially in the consumer credit and NBFC. So in the near future, you will find that consumer loans, which are easily being dispersed by the banks, are declining or on the declining trend. NBFC faces the same thing. And this is especially with respect to the credit card loans, where the insolvency is very high. Share of the term deposits and the certificate of deposits have increased, right, over the current and the savings account. Gross non-payment performing assets are all-time low. So this 1.8% is gross NP, all-time low. It's all-time low. But write-offs are the major reasons. Now, what is write-off? Now, write-off basically means, we have already conducted a video on this channel, so you can go through that, how NP and other things have been defined. So write-offs basically means whatever was negatively written, that let's say 10 crore of loan has not been recovered by a bank. Now it has been write-off. Write-off means it has been removed from the books. Banks may try to recover the loan, but on paper it's not there. So when we remove it from the balance sheet of a bank, balance sheet of the bank becomes clean. And as a result, the banks can show that they are healthy. So this 1.8% of the gross NPA is because of majorly of the write-offs. Now, some biggest thing is the slippage ratio. Slippage ratio means how much of a quality loan is turning into NPA. How much of the quality loans or the lendings are slipping into the NPA. That is slippage ratio. So among the upper layer of NBFC, it is 70%. So the slippage ratio is very high in NBFCs. So their loans are turning into negatives or NPAs. They are slipping easily into the NPAs. Not only that, most of their NPAs, their write-offs are very high. They are writing off 70% of their NPAs, which is a wrong practice. It may seem good in the near terms, but RBI has given a warning for that NBFCs should not do that. They are easily writing off the loans. With this, now we come to the next article. The next article is with respect to, it's a prelims related topic, is index of industrial production. Now, index of industrial production means what? It basically means that India's IIP has now been 9-month low. 9-month low means now the industrial output has just grown by 1.2%. So now we have taken articles from Financial Express and the Business Standard. We have curated them and let's understand what IIP is all about. Now, this is with respect to the prelim examination, so we'll be covering it very lightly. Now, what is the context? Context says India's industrial output grew by just 1.2%. So in the base, it was 100, now it is 101.2. In the month of May, the slowest pace in the 9 months. So in the last 9 months, it has been the slowest. It was almost 6% in the last to last month, but now it is at 1.2%. Downward trend, because previously in April month it was 2.6. It has just half of that, less than half of that. So what's wrong? Why industrial output is very low? And consumer durable shrank for the first time in the 17 months low. Now you can understand this. If you connect the previous article with this article, you'll get the idea that IIP is declining, especially in the consumer products, because people are reluctant to buy consumer products, as shown by the RBI. So the consumer loans from the banks are declining. If the loans are not there, people are not buying consumer goods. If they are not buying consumer goods are not being produced. So IIP is also on the declining trend. So as you can see, UPSC has already asked a question on the industrial related indices. That is 2015, they asked a question on core industries. Moving ahead with this index, let's understand the basics first. So what is this index? IIP. It's a key statistical tool used to measure the short-term changes. Guys, it is monthly. They are giving you monthly data. The volume of production in the Indian industries. How much industries are producing as compared to their base. Whether they are producing more or they are producing less. That's it in absolute in percentage terms or relative terms. Compiled by Central Statistical Office. We have already covered up this topic in the previous discussions. Under the Ministry of Statistics and Program Implementation. Then, objective. It provides insights into the growth and contraction. Growth means over 100 and contraction below 100. 100 is considered to be a base in a percentage parameter of the industrial activity over a given period of time, basically a month. Sectoral composition, highest weightage is given to the manufacturing, 77%, then mining and then electricity, which includes 809 items. So 809 items producing industries, automobile, inputs, consumer electronics, even mobile phones, all kind of industries which are manufacturing are included in this. 809 types of products, 29 types of mining, and electricity itself is a single item. So what has increased over that in the previous year is an index is prepared, and that is how it is showing that what has increased and what has declined. The base year is 2011 and 12. Base year basically means on what basis it has increased or declined. That is what it was in 2011, and compared to 2011, what is the present status. So that is the objective of base year. With this 8 core industry, as I have already discussed this in one of the previous class, today also let's highlight that. Now index of 8 core industries, right? It is produced by the Office of the Economic Advisor under Ministry of Commerce and Industry. So this is a separate index altogether, but it focuses on only 8 industries. See, here there were 809. Out of this, there are some which are core. Core means which are very, very important for the industry, for the economic development. What are those industries? Right? Coal, crude oil, natural gas, refinery, fertilizer, steel, cement, and electricity. So these are those industries. Now many of them are mining also. Electricity was included there also, here also. Natural gas, refinery, right? These are part of mining also. Coal, crude oil, cement, steel, these are part of manufacturing also. So they combine individual performance and take the weightage. The highest weightage is given to the refinery, the lowest weightage is given to the fertilizer. Highest weightage given to the refinery means in this, the index that they are preparing, the highest share, highest weight, highest priority will be given to the refinery products. Here also the base year remains the same, 2011 to 12. Here is your practice question from this section, that is IIP. You can go through that question, you can pause the video and do comment in the chat box. With this, now we move to a very new scheme which was launched. It is a scheme known as Employment Linked Incentive. Employment Linked Incentive basically means now government is going to provide incentive, cash incentive to those manufacturing plants, those producers, service providers which are giving employment to more people. Yes. So 50, more than 50, less than 50, given that criteria, government will provide more financial help to those kind of companies. So if a company which try to hire more people, government will give cash incentive to those companies just because it is generating more employment. Now, this article we have taken from the Business Standard as well as from the Hindu newspaper. Now, this is a very latest government scheme. It was announced, the skeleton of this scheme was actually announced in the recent union budget. Now we have the final scheme. The scheme is going to be run for 2 years, that is till August 2027. Now let's understand about this scheme in much detail. This scheme says, it was announced in the union budget. What is this scheme? The aim of this scheme, what does its scheme wants to achieve? This scheme wants to achieve 3.5 crore jobs in 2 years. 3.5 crore jobs in the next 2 years, because that is the duration of this scheme, and will provide 1 lakh crore as a cash incentive, funds to various sectors to generate employment. 1.92 crore beneficiaries will be at the first timers. Now, who are these? 1.9 crore will be the people who will join the workforce for the first time. So, providing a kind of an employment to these kind of people for the first time joiners will be a good thing. Even industries will be encouraged to provide such kind of benefit to these people. Objective, employment generation. This is the biggest objective because the scheme itself talks about employment. We have similar scheme known as production linked scheme. Here we have employment linked scheme. So here that scheme talks about production improvement. This is talking about employment generation. So this is the biggest scheme with special focus on manufacturing sector. Because manufacturing sector is kind of stagnated in India's economy. Not only that, the employment generation is already also kind of a stagnations in the manufacturing sector. Now India is aspiring for the structural changes. We have already missed the manufacturing sectoral growth. So we are aspiring to increase the manufacturing sector growth in this manner as well. Now, how the money will be provided? Money under this scheme will be provided through direct benefit transfers or PAN linked account. Now let's understand this. Let's say this is the company, this is the labor, and this is government. If the company employs the labor goes to the company. If company provides employment to this particular labor, government will provide incentive. So the company can use this incentive to pay the salary to this person. Although this is a very small amount, right? The maximum amount that government will pay is 15,000. It's a very small amount, but still it is an encouraging amount, right? It will encourage the companies to get money from the government and try to hire people for their specific jobs. Composition. Now there are two kinds of composition in this scheme, part A and part B. Now please pay attention and understand this thoroughly. Under part A, first time employers will be given a monthly wage up to 15,000. First timers who are just joining, just graduated, just want to join a particular industry, 15,000 rupees will be given to them. Secondly, employees will be employer, right? Companies, the one who is hiring the company, will be given incentive of rupees 3,000 per month for a period of 2 years for generating additional employment, and 2 additional years if the company is in the manufacturing sector. So 4 years together. Establishment, that is companies which are registered with EPFO, will be required to hire at least 2 additional employees if they have less than 50. If they have more than 50, right, they have to hire 5. So if a company has more than 50 employees, they will hire 5 extra employees, and government will pay 3,000 per employees per month to this company. If the company's employees are less than 50, they will hire 2, at least 2, right? So every company will have extra employment and money will be given by the government. Now, who will be the agency in this? EPFO. Beneficiaries, targeting first timer. So if a person is getting registered to EPFO for the first time, that person will get benefit. Employees, there's a limit. Not everyone will get the opportunity. If the salary of a particular employee as per the company is less than 1 lakh, only they will be covered under this scheme. Any person who is earning 1 lakh and above, or they are paying the salary of 1 lakh and above, these kind of employees will not be covered. Biggest challenge with this scheme is EPFO itself. Now, EPFO is an organization which is looking into kind of a, it's a saving kind of, it's an organization which looks after the savings. It has nothing to do with employment generation. So why are we providing this responsibility of employment generation to an organization which is working for the generation and encouraging savings with the employees? That's the biggest challenge of this company. The second one is you can have fake accounts, ghost beneficiaries. The companies can show ghost beneficiaries and can take 3,000 per employee per month from the government without any reason. Could be a corruption. So this has to be calculated, but otherwise it's a very good scheme. Definitely, if it is implemented properly, it is definitely going to increase a lot of employment. Look at this, 5, even if the 50 employees are there, it will increase 10% employment in this factory. Less than 50, at least it will increase 10 to 15% there as well. Now, given this, now we come to the last article for today's discussion, that is foreign exchange status. Now, India twice in the last few days has crossed $100 billion mark in the foreign exchange. This happened last year also, but because of the rising rupee, government RBI has to sell a lot of dollars, and because of the US issues, trade issues, high BOP deficit, high trade deficit, government or RBI has to adjust a lot of dollars. We reached almost close to 600. But then because of the balance of payment surplus, because of BOP surplus, we have now been again close to 700. It recently went to 705, but now again 702. So twice it has ended at that position. Now, why I'm discussing this topic, guys? Foreign exchange is very important from the perspective of UPSC examination. Look at these questions. 2022, they asked a question on securities, right? Foreign exchange depreciation, forex related question. Then again, they asked on gold trench, which is a reverse trench. Then again, they asked on remittances, foreign currency. So forex related questions are UPSC's one of the favorite. In the last 4 years, 4-5 years, you can say, they have continuously asked a question indirectly or directly on the foreign exchange or its mechanism. With this understanding in place, let's understand what is foreign exchange all about. Now, foreign exchange in India is managed by RBI. Why? Because RBI has been authorized to be a caretaker, manager of foreign exchange in India. Foreign exchange is a financial asset of RBI which is readily available to the RBI for two functions. It's basically a financial asset. It is gold, it is foreign currency, right? It is available for what? It is available for financing BOP. So whenever Government of India faces any balance of payment crisis, let's say there's a huge trade deficit, how we are going to pay for that? RBI will provide the money. Intervention in the foreign market to check the exchange rate volatility, sell the dollar to check rupee depreciation, which RBI did in the last year, because even in the first quarter of this year also, we see that RBI was very actively managing the foreign exchange so that the rupee prices does not fall too much, rupee does not depreciates too much. So these are the two objectives for which RBI keeps foreign exchange, and not only RBI, every central bank across the world keeps the foreign exchange for that matter. It is as per the RBI, so no other agency can have any involvement in the foreign exchange management. How is foreign exchange obtained? How do RBI get the foreign exchange? Through BOP surplus. Whenever we have BOP surplus, so the amount of extra money that RBI has, the economy has actually, RBI just try to squeeze that, right? It suck out the money, foreign exchange, which is available with the financial institutions, let's say banks. Components, very, very important, guys. There are 4 components of the foreign exchange. The first one is foreign exchange assets, basically foreign currency, right? It includes foreign currency, dollar, yen, pound, euro, right? All those foreign currency which comes to India. Foreign government securities, deposits with other central banks, which is also in the foreign currency. Obviously, if RBI deposits money in the Fed Reserve, obviously it is in the foreign exchange. Deposits with overseas branches of the commercial banks, right? Commercial banks, let's say SBI. Now, SBI has deposits in America because SBI has a branch in America as well. So over there, they will have dollar deposits, isn't that? That is India's money because it is in India's bank. So it has the highest share. In the entire foreign exchange, that is $700 billion, over $600 billion is foreign exchange assets or FCA, foreign currency assets. You can also call it as foreign currency assets, FCA. Then comes monetary gold. Gold with RBI as a part of foreign exchange. So RBI has been maintaining the gold since its inception. Gold is there. Recently, RBI purchased a lot of gold from the Bank of England as well. They are maintaining that gold with them. So gold is kind of an international currency. Third is spatial drawing rights, international reserves of the IMF. So a spatial drawing right, it's kind of average weighted currency of IMF that can only be used in the international transactions. It is not used for domestic transactions. So let's say India wants to make a payment to US, but they don't want to make the payment in dollars. So they can make the payment in SDR because US is also a member of IMF. India is also a member of IMF. So there is a common alternative which is available. Although India can pay the same in dollars also. India can pay the payment in gold also. That is, India can use the first two methods. But India can use the third method also when the first two are not available to be used or the country does not want to use. The last one is reserve position. Reserve position is nothing, guys. It's every member's quota, right, with the IMF. So it's like an emergency fund, right? It is available only under the certain conditions or service fee. Every country uses this kind of a reserve only for a certain terms and conditions, guys. Only when they are either don't want to use the first three or they don't have enough money for the first three. Then only they will use the last one. So it is really used. That's why the share of this is very, very low. So as we move from first to the last, the share goes on decreasing. India, RBI is widely focusing on the foreign currency assets and the second one, which is monetary gold. Now, please understand this gold is not part of the money supply. It is not at all part of the money supply. So keep it outside that. Now, let's look into the international standards, guys. As you can see, four or five countries are there. We have China, Japan, Switzerland, India, and Russia. Now, China has a very high percentage. It is close to $3.5 trillion. Right? The second one is Japan. Japan is slightly ahead of Switzerland and we are at the fourth position. So here we are, India, at $700 billion. One very interesting thing that we will notice, look at this year, 2000. So we are in year 2000. In the year 2000, the share of all these countries were very low, right? Four of them are Asian countries. China, Japan, India, and Russia. They are part of Asia, right? Russia has a sharing model, but obviously, right? So this proves what? This is Asian age, guys. The share of the trade of these four countries show that how important they are in the international transactions. And India is growing as always. As India's GDP is growing, one day you will hear that India's foreign exchange reserve will touch $1 trillion as well. And then India will be on the second position. With this understanding, guys, now I have come to the conclusion for this week's economic current affair discussion. I hope you have enjoyed our classes and you have learned a lot through this video. If you are still here with us on this video, I hope to join. I hope to see you in my batches. So the link is given. I'm floating a batch for specialized general studies economy. The prices is 5,999. The contact number is mentioned over there. The details, the link to join this is mentioned in the description box. All the details of this course are mentioned on the screen. This is going to be the most detailed discussion of economy. Do join me and learn from the best. I am Jateen Bharadwaj. I'm an assistant professor of economics. I am one of the highest scorer in the Civil Services Examination, in fact, in the optional paper as well. And I believe in teaching the most detailed discussion curated only for the UPSC examination. I hope to see you very soon in this course. Thank you everyone. Do subscribe us, join us for the next update.